Certainly, these kinds of events are extraordinarily jarring, and the question of should I go to cash really depends on time horizon. Even though we could certainly see a further hit to valuations, we think that earnings estimates are too high, which is certainly something we can discuss further. There's a certain amount of volatility that we have to see as a feature of equity markets, and something that maybe we've been lulled in a little bit of complacency because we've been in these low volatility up into the right kinds of markets. So it can be very jarring, but not necessarily something that should knock people off their long-term strategic allocations.
So the old adage is you buy on the dip. This is more than a dip, but when do you know it's right to get back in?
Well, I think it's interesting is that it hasn't been much of a dip up until this point. As of the close on Friday, we were only down 3.5%. And what's fascinating is, let's say we test the 200-day moving average. That's only 6% off of all-time highs. And that's a function of the fact that markets have been effectively sideways for the last 5 months. So when we think about buying on the dip, we measure a lot of things that we run what's called a flush deck after the end of trading on days like today. We measure things like percentage of names above their 50-day, percentage of names at new 20-day lows. We'll look at RSIs. We'll look at a whole slew of technical measures, look at put-call ratios, the VIX, all to get a sense of where is fear spiking in markets. And usually when fear spikes, that's oftentimes an opportunity to have the bravery to step in and to allocate. Even if it's not the ultimate low, you know forward returns will improve.
What about, where is the fear then? I mean, because I'm wondering if the fear is widespread and panicky feeling, or is it more in sort of the energy sectors?
Well, we haven't seen fear spike yet. Maybe this morning, given the fact that we're seeing the VIX spike higher. But if you look at broad measures of fear, you're really not seeing it across markets. You still have markets trading at 20 times forward. You're still having earnings estimates that are at 14% growth for 26 and 2027. So there's still a fairly high bar for things to go very right for this market. So we'll continue to monitor things like indiscriminate selling. What you want to see in that back up the truck moment is effectively people throwing the baby out with the bathwater. But this process really probably is just getting started, meaning the fact that we haven't seen any estimate cuts whatsoever to EPS. You still have GDP growth that's expected at 2.5%. And if oil remains elevated, doesn't have to stay at $100 a barrel, but still somewhat elevated, I don't think that we'll be growing GDP at 2.5%.
Now, something tells me we might not. So, but of course, the backdrop to all of this is private credit markets.
Yeah.
And how much of that is a canary in the coal mine for investors who now seem very focused on what's at hand, right? Which is what's happening in Iran.
So when we think about private credit, we have to separate, and they're intertwined, but there are two very distinct risks with private credit. The headline risk, which deals with liquidity and demand for outflows, and then you have the risk of the actual underlying portfolios. And up to this point, it's really been about concerns about headline risks that have hit private credit. This is morphing now into concern about underlying portfolios, because remember, these are loans made to more levered companies that are typically so levered that they can't get access to bank financing in other places. And you're going into it with spreads arguably having been very tight. So we think that this is morphing a little bit more into a true risk off versus just the headline risk.
Cameron, I sit here and I look at the basic public, like I'm looking at John Tucker. John Tucker had a 201k. We had the opening of the 401k envelope. It was painful. And Tucker was brave. He participated in the market. He's killing it. He's got a 501k. We're expecting him to announce this. John, are you announcing your retirement? Is it this month or next month?
Leave you? No chance.
Never. Okay, that's the way retail thinks. I mean, Tucker personifies retail. The VIX 32.04, load the boat. Discuss.
Yeah. Look, fear as an individual investor can be a very jarring and paralyzing kind of emotion, because when your own fear spikes, that typically is a sign that you're going to make a bad decision. But measuring fear in aggregate, what we argue, is very illuminating. So the VIX spiking suggests that fear is starting to percolate higher. It's why we also look at things like put-call ratio. Are people willing to pay whatever it takes for downside protection?
What are you going to see this morning? I mean, retail's not walking away from this market.
No, I mean, look at the Citadel retail data from January and February. We saw record inflows into U.S. equities. So retail has been shrugging off a lot of risk, and they're going into this with record high allocations, which just suggests that maybe there's some complacency in that retail positioning.
Alexis, get one more in here with Cameron.
If this is not a long drawn out situation with Iran, does this market bounce back? Does oil bounce back? Does it spring back quickly, or has so much damage been done that it's going to take some time?
I think that oil can move off of its highs if we see some de-escalation, but it's very unlikely that we return to the pre-conflict lows, simply because there has been a lot of infrastructure kind of damage, and you're going to have more of a geopolitical risk premium that gets kept in oil markets.
We'll talk about the oil chart I've got today, folks, but it's been very what we call stochastic, which is like pointy tops. Like we go up and we turn right around and come back down.
Yeah,
that's the way it is.
And everybody's been banking on that being how this is going to play out. And I think it very much remains to be seen if we can count on that kind of episodic upside volatility.
So our headline to your podcast is Cameron Dawson says, load the boat.
Not yet.
Don't put words in her mouth.
Cameron Dawson, thank you so much for NewEdge Wealth Management.